Having me.
So lots to talk about here, but I'm curious to hear from you what you think the biggest accomplishment was in 2019.
I think just keeping the machine rolling forward with all the headwinds we had. We had some of our customers under a lot of duress and working with them in difficult situations. Pretty proud of that. Staying out of the news with all the communities and all the activity we're doing, and of course the Kinder Morgan acquisition, getting Comp Bureau approval early and closing that early, and then of course early in this year moving or enjoying the Kinder moving that share block so quickly gave us a nice pop. So a lot obviously was done. We had hoped in 19 to get the CKPC lump sum done, but that rolled over. That was a challenging discussion, but we had a great start to 19. The guys did a heck of a job on the big debt offering too. So we finished all the things that we hoped to get done in 19 so early in 20. It just cleared the decks, and here we are.
Makes it easier. One thing I did want to spend a lot of time on was the PDH and PP project. It's obviously a big undertaking for any company. So just describe to me a little bit the investment rationale and the benefits you see to both Pembina and its stakeholders.
Yeah, absolutely. I mean, obviously, starting in the communities, it's a great source of employment, investment, property tax base, really long-term, high-quality jobs well beyond construction, and it's kind of unique and refreshing that you can have multi-billion-dollar projects with all three levels of government, municipal, provincial, and federal, not only supporting you but helping you, incentivizing you to do that. The analogy, I'll just digress for a minute, and have been explaining it this way throughout the day. Back when gas processing started, when people built gas plants for producers, one might have thought that you were getting into the oil and gas business, but you really weren't. You didn't have price risk, and often you didn't have volume risk. So you were in the infrastructure business, you weren't in the E&P business. That's how we think of our petrochemical initiative. We are providing infrastructure to the petrochemical business, and we are trying to remove cost risk, volume risk, and price risk, and we've taken a lot of ground on all those things. And so I would submit that we are not getting into the commodity chemical business. Rather, we are getting into the business of providing petrochemical infrastructure, very analogous to how the G&P business started many years ago.
Right. You touched on risk management, and I think that's a key aspect here. There's another project in the industry that you're aware of, and I just want you to talk about your approach to risk management on this project in particular.
You go back 3-4 years, I don't remember when we introduced the financial guardrails. We socialized those with our board and with the investment community to say, look, we may do some things that are new to ourselves and to you, but our ultimate promise is we're going to be at least 80% fee for service. We're currently closer to 90%. And there's certain things that we're going to hold ourselves to account, and that will be our promise to our investors and employees and others. And so we socialized those guardrails, and we did it very deliberately because we knew we were going to come to the market with this petrochemical venture. So at the highest level, people might have been scared that we were getting into the commodity chemical business. We wanted to set that as a context, and I think that was extremely well done by our team, because when we announced that project, I think it was at our investor day, we had no degradation in share price at all. So people kind of go, oh, okay, I get it. And then we started putting out, we're going to have a partner, so the capital cost as a percentage of our EV is very manageable. The partner has experience worldwide. We have the supply for this project. We're going to de-risk the capital cost. We're going to de-risk the revenue, and we're going to do an extraordinary amount of engineering. We call it an extended class 2 level of detail that once the scope's set, we're never going to need to change scope, which is the kiss of death for complex projects. So we spent a lot of time and effort on all those steps, and I can tell you, getting to 40% fee for service in the time frame we had, getting the lump sum, they were binary outcomes from us, and we saw the edge and look down a few times, but we prevailed, and now I think we're well on our way to having the proof points that this is indeed an infrastructure project.
Yeah, you did describe an important aspect here, the EPC contract. So describe the trade-off you made between cost certainty and returns.
Yeah, I mean, we've been in the market saying that we've contracted 60% of our costs, and that's absolutely true. What we're going to do next, though, is we're actually going to run a little Monte Carlo to see how much of the risk we took out. Because the 60% we contracted was the critical path risk. It was by far the riskiest part of the project. So I don't know what the answer is, but we took way more than 60% of the risk out of that project. And so it was really, when we announced a slight increase in the capital cost, it was really the cost of the insurance policy of laying off that most risky piece.
So that's with the PDH, where you have an EPC.
Right.
How do you view the risk of the polypropylene portion of the plant, and what approach are you going to take there for risk management?
As we've become educated, and it's wonderful to have a partner who's done a bunch of these things, we learned that the PDH there's much more stick-build component to it, so there's a lot more complexity in it. The PP is very modularized, like it's like big IKEA furniture. It comes in a box. If you put it together right, it'll all fit. Some people say, well, they're not that good at IKEA. Luckily, our engineers are. And so it's plug and play. You put it together, and then they just didn't see the cost-benefit relationship of paying a big insurance policy to put the IKEA set together. And then the remaining piece is, building a rail terminal. Office buildings and things like that, and we're good at that stuff. We've done that for years.
Yeah. When you look at just some of the soft spots that might be risks in execution, so I'm thinking things like schedule and whatnot for the rest of the way. It certainly seemed to me when the EPC contract was announced, there was a lot more conviction in the schedule. What do you see the biggest milestones or risk factors as you build out here?
Well, we did extend the schedule, I think, by 4 months as part of that process, and that was, the trade-off we made between a little bit of schedule slippage and paying even more for the insurance policy, because of course, as you tighten the date, the risk to the builder goes up. So we think we made a sensible decision. Of course, we're benchmarking. We have, world-leading experts in this stuff helping us benchmark, what are the fatal flaws of mega projects, where do you get into trouble. We've reviewed all the case studies. So, we think our scope is very tight, and we will have no need to intervene with the contractor, and we have an adequate timeline based on, we're at a P50 timeline for this kind of thing, or maybe even more conservative than that. So we've never done this much work, by the way, Rob, on a project before. We usually class 3 and go, but we've done an extraordinary amount of work on this with a very experienced partner. So we're feeling that this now fits Pembina's risk profile very well.
Does anybody have a question on the PDH before I move on? Okay. Well, you have another potentially large project in the offing here in Jordan Cove LNG. There's been a fair amount of activity on that recently. So what updates do you have for us there?
Well, we're doing well on the ground. I mean, we've got over 80% of the right-of-way, closer to 85. And, I think we could be in the mid-90s, but we cut spending back on that just to turn down our burn rate. For many of you know, we were twice denied by FERC, or I guess our predecessor was. And we think we'll get FERC in the middle of next month. We've had good support locally, a lot of key local approvals, and then it's really boiling down to how do we get the state approval. And we've been working with the state for some time, and I think the size and complexity of this project is frankly overwhelming to the state, and we need to work together to make sure they have the capability and the desire really to approve the project. The governor has maintained neutrality on the project, but for us to have the state have the capability to adjudicate the project, I think we need positive support is what we're learning. We don't have that currently.
Right. So in the circumstance, I don't want to be too presumptuous here, but in the circumstance you do get a FERC approval, what do you envision as a timeline to getting the state approvals?
I don't know.
Yeah.
I wish I could answer that. What I do know is the expensive stuff is done, and our cost to keep advancing permits is really negligible. We're down from 10 million a month to $1 million a month, and so that keeping that option alive to a time when Oregon decides they do want this kind of a project that can substantively offset half the emissions of their state through coal displacement, create thousands of jobs, hundreds of millions of annual incremental tax revenue, which I understand they could really use. I think at some point someone's going to value that, and we'll be ready.
Yeah. Before we talk about the KML acquisition specifically, I just want to hear you talk about your philosophy around acquisitions in general, how they can help your growth strategy.
Absolutely. If you look back now, you go back to Provident, perhaps even further, but let's start with Provident. We were missing a key part of the value chain. So we analogize our company to a store. We had a store, but we didn't have that much stuff on the shelves to go to when a customer came in. And adding the frac capacity, the storage, the marketing, the rail, it provided more services. And when you go to a store and you can get everything you want in that store, it's a better experience than when you have to go to 3 stores. And so when you buy wholly owned, high quality, some might see irreplaceable or scarce assets, they're not cheap. And so, we were able to proactively convince the owners of Provident that the two companies together would be in the best interest of our shareholders as well as theirs. And that worked, and we settled on a price, but it wasn't cheap. But over the years, we originally said, man, if we have one frac, if we could build another one, this will have been a good acquisition, right? And now we're engineering RFS 4. Yeah. So we've driven down that multiple. So it's kind of like buy a platform. It ain't going to be cheap. It's wholly owned. The assets we buy are scarce. Again, some might say one of a kind. And then get to work and brownfield and greenfield around those and drive the multiple down. One common theme that you'll see from everything we buy is it generally makes our existing assets more valuable. So you don't see us buying something in the Permian because it's hard to, that might be a good deal, but it doesn't make the rest of our assets more valuable, and that's the discipline we follow to kind of work our way backwards up or downstream in the value chain.
That's a perfect segue. So with that in mind, how does KML fit with that criteria?
Well, I can tell you right now, the early feedback since the 45 days we've owned that, our pipeline guys are getting asked for not just transportation deals, but transportation and storage deals. So it's already happening that service offering is improved. We had roughly 2 million barrels of gathering capacity pointing at those tanks. Not all of it was oil, of course, some NGL in there, and we never had a terminus. So, the terminus, which then in turn connects to every other egress pipeline, was a missing piece of our value chain. So it was just, ideal. And what made it even better is that, had great customers, some of which, weren't our customers. Like Suncor was never a customer of Pembina's, and now it is. And so the quality and the creditworthiness of the counterparties, all those contracts were quite exciting to us. So clearly a high quality asset base. And you add to that our marketing capability. Kinder did not have a merchant layer over these, and because we have so much inbound pipe capacity, we can market around these assets in a way that might be unique to Pembina. And that's really, when we talked about the 100 million of synergies, we think we can, in the fullness of time, get 50 of that through our merchant capability without a lot of capital. And then the other 50 really represents the pretty impressive list of opportunities that Seller had put forth, and we didn't buy all of them, buy into all of them or suspect they would all work, but we liked most of them, and that's the rest of the business plan.
Just to touch on one potential opportunity there, what's the long-term vision for the Cochin pipeline?
We think it's going to keep doing what it's doing. We just want to keep adding throughput, understand what the pinch points are, what the debottleneck points are. And, in the same way that Pembina didn't have a terminus for all our pipelines, Cochin didn't have, a real terminus, integrated terminus, which is now CDH. So, it was just a pipe, and now it's a pipe that goes into a terminal that attracts every other source of diluent. And so, we envision being able to perhaps keep that product separate, because it is the highest quality diluent available in Western Canada, and allow the people who own that diluent to capture the full value of it.
Yeah, it really feels like a good fit. I did get a question here on the iPad, and I know there's a lot of investors that talk about this, so I'll just ask the question. Pembina is obviously a major participant in the condensate market. Yeah. So what's your view on the market and how it evolves moving forward, given that there are constraints on the export pipeline side? And then on the second part of the question is, how are the diluent recovery units? How do you view those projects, and are they an attractive opportunity for Pembina?
Sure. A lot of our phase 3 to 7-8 growth on Peace has been around condensate. They've been either gas plays with associated condensate or condensate with associated gas. So, the wonderful thing for Alberta was the product we were most short of, which was diluent, is what we're finding. And so that was a real windfall for the province. Demand is still increasing, albeit slow. Our domestic supply is increasing. So, the consuming marketplace always wins, right? For the same reason the Marcellus will back out Canadian gas, because you don't need to transport. So, our view of how the market evolves is the Southern Lights might be the first pipe to turn around, and Enbridge has talked about that. You mentioned egress. We heard from the Premier and TMX. They got pipe in the ground. They're hitting their last mile risk head on, right? They're in Burnaby. I just read that today. So if you got last mile risk, build the last mile first. I think that's super intelligent. KXL came out of the grave. I think a lot of us were a little surprised. Scott and I were at the London conference when Don started alluding to that, so that was a great surprise. We'll see. And then Line 3 got placed into service. Yeah, they still have some state problems. I feel the pain. But there's a lot of optimism around that, as well as gas. And if those pipes all go, or even some of them, that's a lot of egress. That'll mean a lot more diluent. So. When we look at Cochin, we think it's going to keep doing what it's doing for a long time. Now, you bring up the DRU. The DRU that was announced is in the Hardisty area, so we aren't a player in Hardisty really, so I don't know the dynamics of that hub, and I can't speak to their economics. For us, the opportunity seemed, for when we studied DRUs, was the fact that condensate was trading to a premium to crude, and while it was doing that, that's really what backstopped a lot of the capital. our view is if diluent supply keeps growing, that in the fullness of time, that premium will be diminished. If diluent grew a lot, and it became diminished a lot, it might even go the other way. And so it does start to erode your DRU economics. Let's just say 10 DRUs got built for 300,000, 400,000 barrels a day. That would mean a lot more diluent in the market, which would drive down the diluent price, which would negate the needs for a DRU.
Right.
So we could never get out of that thinking when we looked at it.
Right. It feels like we'll run out of time for all these questions, but the one I did want to ask you about was Keyera and their CAPS project, and what impact do you see that having? What are you seeing in terms of customer behavior, recontracting, and things of that nature?
We haven't seen a big impact of that yet. When we become aware of a significant volume, we chase that volume, and so far, when there's volumes available, we've been able to sign them up. Ergo, Phase 9 was backstop in its normal way. When we look at our service offering, we're very comfortable that we have a superior service offering. I mean, we're going to have 4 products, 4 pipe. You can deliver to any frac. We can put your propane on a boat. We can put it through a polypropylene. We can get you to any BC, So there's just a lot of advantages, and we're real. We're there. There's no uncertainty of whether we'll be there or not. And so we're going to just keep doing what we're doing.
So you say you're real. You've had some real progress on the Peace Pipeline system over the last few years. What more can you do there? How much more can you grow that system?
Well, I can tell you, when we did Phase 3, we thought we were done for a long time, and we had a couple 100,000 barrels a day of spare capacity, and it got mopped up in 9 months. So I guess I would say that if, as Shell LNG comes out of the ground, and I'm going to bet you there's another LNG, West Coast BC LNG, announced in the next year or two, and we just talked about all the oil pipelines.
Yeah.
I don't know what the limit is. That that's all of those. What I just mentioned could be a 50% increase in gas exports and a 50% increase in oil exports. Well, Pembina has never seen anything like that in the last 2 decades. So I don't know. I think the machine will keep rolling.
Oh, that's amazing. I'm sure you get your fair share of ESG questions as you market on the road. You have a carbon stand. Tell the market about I think you already addressed some of the governance issues through the guardrails, but tell the investors a little bit about the carbon stand.
Well, maybe I'll just digress for a minute. I really liked what Kenny said today about we have a great S story, we got a great G story, and there's no sector CEO I don't know that is working on this.
Yeah.
Or isn't working on it, I should say, and as are we. And so our stand really says that for every business, and all our businesses are very different when you contrast a petchem business to a gathering and processing to a pipeline, we have to separate it into businesses, or else Pembina as a whole makes no sense, that we're going to reduce the carbon intensity of each of those businesses. And so I think the biggest thing a company can do with that as a framework is to start talking about how new projects impact your carbon intensity and what options you have to drop your carbon intensity. I think what you'll see out of Pembina in the next year or two is we're going to put some real targets there. Our stand is directional in nature. It's not. Usually Pembina is extremely goal oriented, and so we recognize some specific goals are missing there. But as we learn more about this area, I think you'll see some goals come out.
Any questions from the floor? So a couple quick hitters in some of your potential projects. What has to happen to make expanding Alliance Pipeline a reality?
We need to find a way to get that flared volume out of the air.
Yeah.
I mean, when we came into it, we were probably a little naive and said, look, there's 400 million a day going up in the air. We got an economic 400 million a day expansion. Any questions? We found out that, a bunch of the lands associated with that flared product are under dedication to certain other people. Yeah, it's not like there's, 4 big flares of 100 million a day each you can go get. It's dispersed.
Right.
So we probably have to build a network to collect that. Of course, people are still drilling and stuff too, so that should be easier. But I mean, the opportunity in that is we may have infrastructure opportunities in the Bakken to make that happen. But we think the more realistic model is that we do those in tranches of 50 or 100 million a day over
Right.
time, as people drill, as contracts expire, and as we build that kind of gathering backbone that it takes. The good news for us is, the first 100 million a day is extremely accretive because we don't have to expand much. We don't have to do anything at Aux Sable, very little on Alliance. And, so the biggest prizes will come early in terms of accretion.
Right. You also talked at your Investor Day about the potential for Northeast BC frac. What are the updates there? How's that evolved?
Well, very well. We have advanced discussions with the railway. We've got land. We've secured the land. But in parallel, of course, we're developing RFS 4, not surprisingly, and it's not very tough for us because we built that plant twice before. And then the trade-off will be, clearly NEBC will be more expensive. We don't have the salt there. We don't have all the egress, the rail,
Right.
and all that. But if you bring product to NEBC, you don't have to pay the piece toll. So you're saving a bunch of money there. Your frac fee's higher. You're not paying a big piece toll. And on paper, you're closer to the ocean. So maybe you can export your propane or butane. And so you would think on the surface that rail would be cheaper. But it's small quantities because the rail capability off the main line are very constrained. So your cost per unit on rail is much higher than a 100-car unit train
Sure.
out of Redwater, where you actually already have all the rail facilities. So that let's just assume that was a tie overall. It's really going to boil down to the customer's view of which market they want to go to. And that's not just for propane or butane, because maybe there's an ethane demand too. And let's just say there was a strong ethane demand and someone was willing to pay for, it would bias the location back to Redwater a lot more than if it was a C3
Right.
plus frac. So
Right.
all those things are interplaying, and we're going to develop 2 good options and let the producers choose.
All right, it sounds like the market still needs to sort that out a bit.
Yeah, it does. Yeah.
So what do you envision as Pembina's role in the ethane value chain?
As a supplier for now, there would be, I think a number of billions of dollars involved in procuring enough ethane. I mean, we have all those projects. They're all ready to go. And for those who don't know, we transport most of the ethane in the province, so we're in the middle of the discussion anyway. But it's turning those ideas into real projects would involve a pretty substantial build out of many billions of dollars. We don't expect Pembina's going to build all the incremental ethane facilities, but we could envision us building half or maybe more than half of the ethane facilities, but also be the leader in the transportation of that ethane.
Sad to say we're already out of time. Thanks very much for your insight.
Thank you.